Good afternoon. Thanks everyone for being with us today. I'm Adam Newman. I'm a partner and senior wealth advisor with Bernie Wealth Management, and I'm going to be handling today's presentation titled The Hidden Risks of Your Investment Portfolio. I hope everyone's been enjoying the start to 2021 and staying safe and healthy. I'm excited for today because the information we're going to cover is relevant and I think it's also timely. As investors, a big part of our job is continuing to ask questions. We need to question our process, our way of thinking, and honestly assessing how we've been able to handle tough market environments. And the presentation's organized in a way that I think it's going to help us all ask questions together and identify where there might be gaps in the way we approach the markets and build our portfolios. So my primary goal is to give you all some actionable steps and items to consider as we look ahead in an uncertain environment. Before we get started, I want to just cover some quick housekeeping items. First, I'm going to do my best to keep the actual presentation just under 45 minutes. But please just know if you've got to hop off at any time, we're going to be happy to send you a recording of the presentation over the next couple of days. And also in the interest of time and given the wide array of questions we'd likely be getting, we're going to hold off on taking any questions live. So for that reason, I've directed everyone below on the left, bottom left corner to an email address, seminar@berniewealth.com, that you all can access and utilize and send whatever questions you have. If you want to request a copy of the recording of the webinar or the slides, just shoot an email to this address down below. And I'll also pull this up one last time towards the end for your reference. So with that, let's get started. This presentation's been around for a while. It's evolved over time, but it really accurately reflects the kinds of conversations we have with our clients and prospective clients about building portfolios, and with that, identifying the risks and opportunities that are out there. It's important, before we move ahead at all, it's important to remember we're all investing for specific goals, and it's imperative that our portfolios and behavior are aligned with those goals in order for us to be considered successful long-term investors. So we've broken this down into four parts. Part one is going to be a reflection on the market events of 2020. So what happened and how does that compare to more recent bear markets? Part two is going to focus on investor behavior during the 2020 sell-off, as well as past sell-offs prior to that. And I'm going to use this section here to highlight and provide some tips to help us all safeguard against bad investor behavior in the future. Part three, I'm going to focus on identifying the key drivers of our portfolio's risk and return profile, mainly by answering those key questions like what really matters when choosing investments. And specifically to do this, I'm going to use a case study as a way to provide tools that will allow you to look under the hood of your current portfolio to identify some of these potential risks and identify areas for improvement. And then finally, I want to provide just a little bit of insight in how we chose to manage through calendar year 2020 and the challenges that came with it. And most importantly with that, how did we choose to communicate with our clients during this period? And with that, I'll give you some final tips and questions to ask yourself or your advisor when it comes to managing volatile markets, because as anyone on here knows, it's a part of the natural course of investing to have volatility in bear markets and corrections, and they're going to happen again. So in order to be successful, we need to continue to learn and improve over time. So let's start by looking at the market behavior during what we consider to be the heart of the COVID-19 sell-off last year. And this really begins back in mid-February of 2020 and continues through March 23rd, and that would be the day that we would identify as being the bottom of the market, after that, really sharp sell-off. And a majority of the focus in the financial media and the headlines, it always tends to be on the S&P 500 and the Dow. And both of these indexes, they really only represent a fraction of the overall stock market and the overall opportunity set when it comes to investing. So we're going to be better than that, and we're going to look at a much broader set of the investment landscape. And most specifically, we're going to look here at the four broad stock asset classes and the three main bond asset classes that make up what I would say are a majority of the portfolio building blocks for investors. And our first lesson and first takeaway as we evaluate this information is that not all stock categories are made the same, and certainly not all bond categories are the same. We're going to build on this concept as we move forward. But just for now, notice the differences in the risk profile of these categories. And now that we've looked at the ugly part of the year, let's see what happened from that bottom of March 23rd through the end of 2020. And what you're first going to notice is that the categories that initially sold off the most also experienced the strongest recoveries. Some of these asset classes, like U.S. government bonds, they hardly moved through most of the year, and they actually, you could argue, they were pretty boring from a volatility perspective, while other categories, such as small cap stocks, had significant up and downward movements. So to learn from our experiences in the markets, we need to understand the behavior of these different investment categories and then determine which of these should or should not be in our portfolio. This is called the asset allocation decision, and we're going to talk about this quite a bit. And although each of these market sell-offs, they feel new, we've all caught ourselves at some point saying those 4 most dangerous words in the investment dictionary. This time is different. Yet the behavior of these categories is actually very similar each time. So because of this, coming up with an asset allocation plan outside of return or what happens in the short run, it's going to help us provide a level of predictability, and it's going to help us set guardrails for our upside and downside potential. For example, someone who's got 50% of their portfolio across stock categories and the other half across some of the bond categories, you would expect them in most market environments to have a more stable investment experience versus someone who's got their entire portfolio in small cap stocks. So the risk associated with each of these asset allocations in each of these asset categories is very consistent through time, and that's going to help us with our behavior and our decision making. And if we take a 40,000-foot view, this is going to give us a good visual snapshot and representation of the COVID sell-off and recovery in stocks. And what we're soon going to notice is a lot of these sell-offs look the same. So this is here, I've toggled back and forth between what happened last year and what happened back in 2018 when we had that 20% decline in stocks that happened in the fourth quarter of the year. So you look at this and you think, maybe these similarities will allow us to act on these movements from a timing in and out of the market standpoint, but reality and our behavior are going to tell us otherwise. Most investors are notoriously terrible market timers. And this chart is the third layer of this, which is going to look at 2008. Notice a great financial crisis. And you see here, the pink line is the performance of the S&P 500. Looks very similar from a downward and then upward movement compared to the 2 subsequent bear markets that followed it. And down here, you see this blue mountain chart, which is investor allocations into cash. So what you see here is that this blue mountain, kind of builds on itself and then levels out. It shows that cash allocations increase literally right at the bottom of the market. And what I think is even more worrisome is that these cash allocations, they stayed elevated during a lot of the recovery. They never kind of got back down to where they were in 2006. They stayed at a flat baseline and had a lot of investors, questioning the recovery and keeping cash on the sidelines. So investors sold at the worst possible time, and then they took too long to recommit themselves, missing out on significant recovery opportunities, and most importantly, lowering their return potential for their goals. It's a little early, and data is still coming in. This data tends to lag by sometimes a couple of years. But Fidelity released a study about halfway through 2020 confirming what we would expect, which is that a significant percentage of investors went to cash during the COVID sell-off as well. What's even worse is that a lot of these investors were in and around retirement age. So bailing on the markets and missing out on what now are often are very quick and surprising recoveries, they can damage our return potential, but also our financial plans by creating what we call unrecoverable damage to your long-term return potential. And these recoveries typically happen well before things feel safe again. And we all saw this last year. We had a horrible economy. We had a lot of things to point to as worries in the market, here and across the globe. Yet we still saw record movements in stock prices that have really continued into this year as well. So a lot of these investors who end up bailing, they're usually either taking way too much risk to begin with, or they didn't have confidence in their plan and their future. And if I can highlight anything, it's that. It's the role of a good advisor is to make sure that you've got those two areas covered. But why do we keep doing this? I'm going to provide two explanations that I think make sense. The first is our brains, and the second is our process. And there's been a lot of studies released on how investors significantly underperform the markets over time. And some of the more prominent studies, like the ones put out by the Dalbar Institute and Vanguard, they actually quantify this and show several percentage points of investor underperformance per year. And that's a big number if you add that up over time. And this is not necessarily because people are bad stock pickers or bad at selecting mutual funds. It's all our behavior. Collectively, investors sell low and they buy high. They do the exact opposite of what they should be doing over time. And we could probably talk for a whole day about why this is the case, but it really boils down to biases that we have and perceptions that we have about our ability to make winning portfolio decisions. A couple big ones are, number one, we're generally overconfident in our abilities. Number two, we place way too much emphasis on recent market performance. So in our minds, the trends that have been transpiring and what's worked in the market must be working now and it must work in the future. We only like to look for information that confirms what we think is true. And this is magnified by how easy it is to access information today. We'll go on internet search, scavenger hunts to look for things that make us feel good about decisions we've already made. And then we're going to do whatever we can to avoid short-term losses, even if it's at the expense of our long-term gains. And even when we know that these bear markets, these short-term sell-offs, it's all part of the stock investing experience. So that's the mental part of the battle. And then we've got the process end of things to worry about. And something we're a really big believer in is having a clear process to managing market volatility. It's going to help you avoid common mental mistakes, and it's going to help you stay in the market when we know we need to over time. So here are some things that we consider as maybe our recommended playbook for handling volatile market environments. Number one, set clear expectations and understanding the volatility that comes with investing in stocks. So something we like to do is educate our clients on past sell-offs and recoveries, use data for reinsurance, point out that, although the headlines surrounding a market correction might be different each time, the actual movements in the markets and the behavior and the cyclicality of it is actually rather consistent. Number two, encouraging our clients and investors to avoid obsessively and frequently checking their account balances every day, every hour. We're huge believers in the power of information and understanding how you're invested, asking questions, but sometimes too much information and too much checking in on your portfolio can be harmful and counterproductive. Number three, staying clear of those all-in or all-out decisions. And we're going to talk about this during the asset allocation review, but this really means don't think of investing as being either 100% in stocks or 100% in cash. There's a whole spectrum in between that you need to consider and understand. And then lastly, and this is the big one, having proactive and frequent conversations with a trusted advisor to stay on track. CNBC, any kind of financial media, they don't have any idea about you, your goals, and what should be relevant to you, but a good advisor absolutely does. So with the behavioral and market history piece of this behind us, we're going to jump into some actionable ideas, starting with the correct order and how we might want to review and evaluate your current portfolio. And I think the easy way to do this is through a case study. So we're going to break down a prospective client portfolio through the lens of a professional investor. And I have to just note that what we're going to look at here, it doesn't represent a recommended portfolio but it's a portfolio that someone actually brought to us and asked us to analyze and make observations on how they're doing. So the type of analysis and the way that I walk through this in terms of the back and forth and the observations and the recommendations, it's something we're going to offer to everyone in terms of a complementary analysis for joining the call. And we always want to start at the top with asset allocation, which is this is the most important decision that you're going to make for your portfolio. And if we define asset allocation at the very highest level, it's the percentage that you choose to allocate your portfolio across different investment categories. And in terms of the importance of this decision, there's a lot of research out there in the academic world and institutional world that found that asset allocation it's going to explain around 90% of the variability of your returns over time. So while a lot of us get caught up in the decision on what stock to buy, what fund to pick, most of the ups and downs and the return potential of your portfolio, your overall investment experience is defined by what percentage you choose to put into each of these buckets. So as we look at here at this sample investor, they've got just under 70% of their portfolios in equities and a majority of the remaining 30% or so in bonds and cash. So given the higher weighting to stocks, we would consider this a moderately aggressive allocation. So if an investor wants higher growth potential and they're okay with short-term volatility, typically what they do is they'll increase their stock allocation. And if investor wants lower volatility and they're okay with lower growth potential over time, they would typically decrease their stock allocation and increase the bonds, alternatives, and cash end of the spectrum. So that's the main lever that you pull when you think about how much my portfolio might move up and down as it relates to certain market events or over time. The main lever you pull is what's my exposure to stocks versus other categories. And another part of understanding asset allocation is what's the overall concentration of the portfolio's holdings, meaning how many investments are in your portfolio, number one, and number two, what are their relative weightings? So if you look here, we specifically broke down this investor's exposure in their top 10 positions to help us just, it's a gut check. It's the ability to quickly see, are there specific investments that make up way too much of the overall mix? And, we've seen clients come in with 20, 30, 40% of their portfolio in a single stock, and that warrants a serious discussion around, what does that do in terms of impacting risk and how, what's the level of urgency of, starting to diversify and spread those assets elsewhere. You think of this is a great time to be thinking about this because if you look at what's happened the last year in the markets, some people with big exposure to some of those hot tech stocks that have really run up, they might have performed very well and they might still be performing relatively well, but they might now have made up a way too much of a piece of your portfolio. So part of being a disciplined investor is at any point in time being able to call time out and say, here's where I am, here's the risk factors associated with this, and not on a backward-looking basis, but on a forward-looking basis, what changes do I need to force myself to make to run ahead of whatever might be in front of us? So I just want to refresh, for definition and understanding purposes, what some of these major asset allocations are. And I think there's four to focus on for now. And the first is obviously stocks, whose primary purpose, if you think of what's the main goal, is to help us build long-term wealth. And stocks are, we're big believers in the idea that stocks are the main driver of building wealth over time. They're the highest returning asset class over long windows of time. It gives you the best chance to outpace inflation. So that's the benefit of stock and the importance of thinking long-term when it comes to your stock portfolio. But the price we pay for that is the short-term volatility. Second are bonds, which are really there for stability and then second for income. And the good thing about mixing stocks and bonds is that bonds, they tend to not behave like one another. So bonds especially don't behave quite like stocks do in volatile markets. So there's a balancing effect that takes place when you hold the right kinds of bonds in your portfolio. And we'll dive into that a little bit deeper in a minute. The third asset class would be alternatives, which we would define as anything that's not a traditional stock investment. They're really there for diversification and return enhancement, and they're usually reserved for higher net worth investors. So given the wide range of variety and the unique considerations that come with alternatives, I'm going to steer clear of going any deeper into those for today's purposes, but we're big believers that alternatives should be considered for the right client and then the right percentage as a way to help balance out your stock and your bond mix. And then lastly, we have cash, which is there for short-term emergencies and liquidity needs. So a couple of things to highlight regarding asset allocation before we dive back into the case study. Number one, your asset allocation should be clearly identified and monitored. The last thing you want as an investor is a random basket of holdings with no identifiable asset allocation target. If we know that the asset allocation decision is going to explain most of our return experience, we have to spend time determining and monitoring it. And so that's especially important as you get into thinking about life transitions, spending money from your portfolio, retiring, saving for any kind of a big goal, all warrant, a revisiting of the asset allocation, conversation. And second, your asset allocation should really be a function of two things. Number one, your appetite for the swings in the stock market. This is known as your your risk tolerance. So if someone is uncomfortable with stock volatility and they find themselves selling stocks during bad markets, they should, based on this rule, have a lower allocation to stocks than someone who's more comfortable accepting the ups and downs of the market. So this is really important because understanding your risk tolerance in the right way helps keep you invested. It keeps you comfortable and less prone to selling at the wrong time. And then number two, your asset allocation should be tied to the rate of return that you need to generate to meet your goals. And this number, the great thing about this number is it's different for everyone, and it's an output of your personal financial plan. So a good plan is going to tell you what's the exact percentage that you need to earn on your portfolio in the context of your income, expenses, health, tax situation, just to name a few. So investing without a plan is a bad idea. Plan's going to give you peace of mind, and it's going to give you a level of certainty about you being able to live the lifestyle you want in the future. So don't chase returns that aren't tied to anything specific. Saying I want to earn 10% on my portfolio a year without context on what that means or why that's important can be very dangerous and can lead to riskier investment decisions. And what we found is that investors that bail on the market and that make knee-jerk decisions on their portfolio, they usually don't have these items covered. So I'm going to give you just a couple of quick examples. When you think about what the different asset allocations look like at different levels of risk, I just wanted to quickly plot out some. Think of a spectrum on the left from conservative to aggressive. Some sample portfolios to help you understand, for each step up the risk ladder I take, what am I gaining, what am I losing? And these aren't actual live portfolio performance numbers or returns. These are based on, just general market indices, but in certain weightings relative to the type of risk we want to take. And I think they just give us a good eyeball test and a good benchmark on what's that risk return trade-off and what does it look like. So you notice very simply for an investor in a conservative portfolio, their worst case scenario is a lot more manageable than the aggressive investor. The return is lower, and for that, the big driver of it is the type of asset allocation that lines up with it. So, someone who needs to earn a specific rate of return and has a certain appetite for the ups and downs in the market, this gives them a good educational exercise to go through and say, well, what might make sense for me, based on my tolerance, based on my target return. And then that gives you a very predictable investment experience that doesn't force you in a position where you're just trying to chase the market or get caught in a box of uncertainty. And so once you have a clear understanding of what your asset allocation needs to be, we can't stop there. And I think a mistake a lot of investors make today especially with a lot of the tools available online to self-manage this, is they set an asset allocation policy, and then they just kind of fill each of these buckets with an index, or even worse, a random pool of what they think are top performing investments. For example, an investor with a 70% target stock allocation, they might say, okay, I'm going to achieve that target with an S&P 5 index fund and a basket of high-cost mutual funds, or a random collection of blue chip companies, and move on. But I'm here to point out that not only history, but a lot of academic research is going to point us to do otherwise. And so I'm going to explain this a little bit further. But just like the asset allocation decision, I said it explains about 90% or so of your stock, of your expected return and volatility of your portfolio. A very similar concept is going to apply within your target stock allocation. And what I mean by that is about 90% of the ups and downs within your stock bucket are actually explained by what we call the size and style decision. And size is your allocation across large companies versus small companies. And style allocation is your decision between value versus growth companies. So rather than fixating on, again, what individual stock or mutual fund should I buy, most of the performance within your stock allocation is going to be driven around what percent do I have in large versus small cap, and what percent do I have in value versus growth. And this is something a lot of investors, both retail and professional investors, miss and don't pay attention to. So if that's a little bit confusing, don't worry, because I'm going to use this example, and I think this is going to help round things out, quite nicely. We're going to go back to our case study, and if you remember, this client had just about 70% of their portfolio in stock. And what we're doing here is we're looking under the hood of just their stock allocation. So, okay, I get that they've got 70% in stock, but what kinds of stocks are they holding? What's the makeup of those companies? And so what this tells us, looking at the bottom here, is that about 90% of their stock allocation is in large cap, and about 50% of their stock allocation, the predominant percentage of it, is in growth companies. And so the first question that I like to ask any client is this on purpose, or was this an accident? And, but both answers are fine, and it helps us, get a good starting point for the discussion. But the big thing that we want to arrive at in the end goal here is, why the large and the growth tilt? And is this a good or a bad thing? Was my decision, or this investor's decision, to overweight large cap and growth good or bad? And the answer is, it depends. And we're going to use this here to further help us understand that. Specifically understand how these size and style cycles operate, and how positioning your portfolio accordingly can help us jump on another opportunity set for our portfolio. So again, here on the right, I've got year by year. This goes back to 95, and it runs through 2020, as much as I could fit on the slide. But what I want to show you is the return differentials each year between small and large company performance and value and growth company performance. And this is what we're really getting to. So if any calendar year in the first column, the number is negative in red, that means that large cap outperformed small cap that year by that percentage. And if it's, we're looking on the right and it's blue and positive, that means that value outperformed growth that year, and vice versa for both. So if in the first column it's red, large cap outperformed. If it's blue, small cap outperformed. On the right, if it's red, growth outperformed, and if it's blue, value outperformed. So you can just, without really understanding year by year what's happening, the key takeaway here is that there's very big differences on a year by year basis, and there's some sort of cyclicality to it. So if I average this out over time, what you notice is the average return difference between large and small companies over time is almost 8% per year. And the average style difference over time is almost 10%. So that's a big difference. And the key here is cyclicality. So this investor's decision to be overweight large cap and growth companies would have been a great thing in a year like 2020, where you see both large and growth companies really outperform, but would have been a really bad thing in a year like 2001. So that's where positioning and your decision making within your stock bucket are really important. So here's a visual of the size and style cycles, which kind of take the numbers out of it. If you're more of a visual learner, this helps you kind of get a snapshot of what this looks like over time. And you notice, first, focusing on the size piece of things, if we're above that middle line and you're moving up the mountain here on the blue end, this is the pro small cap market. And if we're down here in the orange zone, it's a pro large cap market. So it kind of looks like waves over time. You see the cycles. So an investor who is overweight large and growth in a pro small cap market, or overweight large cap in a pro small cap market, then they're really putting themselves behind the eight ball. And then vice versa. If we're in a large cap market and you're a purely small cap investor, you're facing headwinds when it comes to the risk return profile of your portfolio. Same thing with value versus growth. Here you see on the top, anything that's blue above the center line is representative of a pro value market, and down here at the bottom we see pro growth markets. And again, you see some really sharp differences over time and what that means for us. But something that we're big believers in is not just statically handling the stock piece of your portfolio. It's understanding the size and style cycles and then making changes over time to try and capture these differentials. So once we have our target asset allocation and we know how we want to position across size and style within our stock bucket, what we then have to do is take the microscope over to our bond portfolio. And I think this is where a lot of investors get tripped up and make a majority of their mistakes that lead to risks that they didn't think were there. So going back to our sample client again, we're going to break out the bond portfolio just like we did with the stock portfolio. So we said that about 30% or so was in bonds and cash. All we're doing here is isolating that on its own and then looking under hood to see what we have in the portfolio. So we're going to break down the bond piece into several parts. First is you see average duration. And so what that's really saying in simplest terms is how long on average until the bonds that this investor is holding are expected to mature. So this includes bonds held inside the portfolio directly alongside any bond mutual funds or ETFs, which often aren't as transparent. So this client has what we would define as a relatively short to intermediate term portfolio with maturity dates in the 5-year range. So that 5.64 means that most of the bonds in this portfolio mature in the next 5 years. Durations that are much longer, say 7+ years, could be a source of volatility when interest rates rise. So remember that when rates go up, the prices of our bonds go down. That's what a lot of people are talking about in the media is, are we going to hit a bad, bear market in bonds? And the answer is not so simple. It's the type of bonds you're holding. Shorter term bonds with shorter maturities will be impacted much differently than someone holding 10, 15, 20-year bonds, which absolutely could see a drop in price that's pretty significant. The next thing to observe is the average yield, which we see here is just under 2%. So that's the weighted interest payments, how much income is being thrown off from my bond portfolio. And then lastly is credit quality down here at the bottom. And this is, simply put, credit quality is an indicator of risk. And the main and most damaging risk of a bond investment is default, which means whoever you loan the money to, they can't make the promised interest payments, or even worse, they can't repay all the principal at the end of the term. So bonds rated BBB or higher are considered investment grade or high quality, meaning lower risk and lower return. And bonds rated BBB, lower than BBB, are considered high yield or junk bonds. So you see this investor, they have some meaningful exposure to junk bonds. And a lot of times, and we've seen this in the low yield environment we've been in quite often, is a misinformed investor, they're only going to look at yield and they're going to end up with a portfolio of very high risk bonds without understanding that there's a very strong correlation between high yield and high risk. There's no free lunch. That term gets thrown around quite a bit, but if you search for higher yields, whether it's even dividend yield, if we go back to the stock end, high dividend yield, high bond yield is often very strongly correlated to volatility and risk potential. So something really that needs to be paid attention to. And I'll give you some more context regarding that as we look back at last year and what happened in the first quarter when the COVID sell-off really kicked in. So notice the significant return differences between the high yield bonds, the government bonds, and the corporate bonds during the sell-off. And that's a very important part of the asset allocation decision within your bond mix. So just like the stocks with size and style, we have to make important decisions on how do we want to position across these different types of bonds. Our preferred approach is to stick with the higher quality investment grade bonds, use those for balance, and then if you're going to take risk, take it on the stock side where you're most likely to get paid for it over time, meaning we know stocks have the highest level of return over the long run. They're most likely to help us outpace inflation. If we're going to take any kind of risk in our portfolio, let's allocate it to the stock end and let the bonds be stable in the short term, even if it means less yield. This is a process known as risk budgeting, where you want to take risk in your portfolio and understanding why. So in kind of tying this in with the stock piece and the returns and what happened last year, an investor who had 70% of an allocation to stocks and then 30% allocated to bonds, but all of those bonds were high yield or junk bonds, they would have seen their portfolio fall almost as much as the overall stock market. And they would have done that potentially without knowing the risk they were taking on the bond side, which might have forced them to push the panic button when they saw what their losses were, not understanding that they weren't as balanced as it appeared in the first, start of the year. That's where you start to make really bad and misinformed decisions, not understanding the actual level of risk you're taking, and then that in turn reintroduces those bad behavioral tendencies that we have, that we know a lot of investors are prone to, like selling out at the wrong time. So let's wrap up with just some findings on the case study and the allocation discussion before we move ahead. Number one, take time to get that asset allocation decision right. What kind of risk should you take and why? And I think this decision should really be revisited annually and whenever life changes, and use an expert to help you if you need someone to guide you through the process. Number two, within the stock allocation, how are you positioned across size and style? Remember, if we add up asset allocation and size and style decisions, those factors are going to explain a lot of your risk and return profile. So don't get caught up paying attention to things that are less important, that don't have as much of an impact long term. And then lastly, what's going on in your bond mix? Are you taking too much risk? Are you stretching for yield? Are the bonds there to provide stability first and foremost, as expected and as we want to see over the long run? So while a lot of what we talked about today is timeless and can be repeated, through all different kinds of market environments, I wanted to take a quick moment to reemphasize what you should or shouldn't do with your portfolio during bear markets and corrections. And given what's happened over the last year, I thought the best way to do this would be to provide a summary of, what were some of our actions and what was our communication with clients through 2020. And one of the common questions we received very early on in the COVID sell-off was, what should we be doing right now? When we see losses in our portfolio, the first inclination is we want to take control. We want to stop the bleeding in any way we can. But in our 5 decades or so of experience, we've developed and fine-tuned a process that I think really helped us to guide clients and keep them disciplined through all of last year. So first, we're big believers that when you have these market-wide sell-offs like you did last year in 2008, sell-offs where no matter where you are in the stock market, you're going to be punished. You want to avoid making hasty decisions based on emotion and reactive decisions. So our stance in those instances is to let things play out, and then when the dust settles, take a look at the opportunities. Take a look and see what's oversold or what's more attractive now than it would have been 6 months ago. And so how do we translate this to action? So towards around the end of March, what became apparent to us is small caps look great. So we made a sizable shift in our stock allocation, moving from large to small cap, and going back to managing size and style. We know the cyclicality of this, and you've got to monitor, the relative attractiveness of one versus the other. And that's something that really became apparent to us in March. Is small caps tend to get hit really hard when markets sell off because they're a little bit more volatile than large caps. So that overweighting in small cap and that change really, really helped us through the back half of last year as small caps recovered sharply and into this year as well. Number three, in any market sell-off and in last year, that's a perfect time to rebalance your asset allocation back to their targets. So, for example, if that client that was supposed to be 70% stock and 30% bonds, if because stocks had sold off significantly and the value of their stock positions went down, let's say now they're 65-35 stock to bond, well then that's a perfect opportunity to do what a lot of investors can't do, which is buy low, sell high. So you've got a 65% weighting in stocks now. It should be 70. Now's a great time to sell off some of those bonds, which have likely held up well during the sell-off. Use those proceeds to buy an additional 5% allocation to stock at a low price point. It's a very simple discipline mechanism to help yourself do what a lot of people aren't able to do based on their emotions, and it's rules-based. It's very simple. If my stock allocation falls, I can replenish it. And then next, and this is for taxable accounts only, but we're big believers in implementing tax loss harvesting. So anyone on this call with a taxable account, you're obviously mindful of tax activity. You don't want to let taxes sway all of your decisions, but tax loss harvesting is a practice of selling certain positions at a loss and then taking the proceeds to buy something what you might think is more attractive, but then you've got losses that build up over time that you can use to offset future capital gains. So when you've got a handful of positions in a taxable account and you've got a very broad market sell-off like we had last year, it's inevitable that some things will now be in loss territory. So instead of trying to hold your losers, just that's another behavioral bias, loss aversion, holding your losers too long, thinking that they're going to someday turn around. Instead of holding on and holding out hope for loss recovery, you take your losses, you reinvest your cash into something else, and then if you have capital gains or other things of that nature during the year, now you've got losses to lower your tax bill and help offset that. So that really helps improve the after-tax return of the portfolio. And finally, a great client-advisor relationship is all about trust and communication. So when we hit these kinds of markets, we don't want anyone to feel like they're in it alone. So we go through it as a team. Everyone's in it together, and it's going to happen again in the future, and we're prepared to do the same thing. And that involves direct communication with our clients. That involves hosting a series of webinars, town hall events, Q&As for clients to keep them up to speed on what's happening, and really helping them understand, that we've got our finger on the pulse, and that we're being proactive and not reactive. So I'm going to leave you with this, especially with the sense of calm back in the markets. Now is the perfect time to ask yourself the following 3 questions. Number 1, am I appropriately positioned going forward, whether it's asset allocation, your stock portfolio, your bond portfolio? This is, you want to operate from a position of strength. Although the last week we've seen a little bit of volatility, you want to make changes, evaluate your investments. You want to do that at a time where you're being proactive and not reactive. So we know volatility will eventually pick up again sometime soon. You don't want to get caught, flat-footed when that happens. Now's the time to take a look at this. Number two, be very realistic about your feelings and behavior around what happened last year, in the first part of 2020. You know, did you make any reactive decisions? Were you not happy or satisfied with, the way that you managed through the market or the way that your advisor managed through the market, knowing what you know? And, how might that hurt in the future if changes aren't made? And then three, how often and when do you act on potential future opportunities? So, do you have a discipline to monitor and act when necessary? It's the root of it. So, I said earlier about being able to take a snapshot in time and look forward, not backwards. Not what's done well, not what did I do that really worked last year. It's where am I now, and what changes do I need to make to better position myself for what's ahead. So, and a lot of this is, and I think a big reinforcement to that is having a financial plan in place, and something that's going to help you remove the emotion from investing and keep you on track. So I know we've covered a lot of information. We're just about dead on the 45-minute mark here. I want to thank everyone for their time and attention. And again, please forward any questions you have to seminar@berniewealth.com. I promise we'll get back to you over the next few days, whether it's a question, the recording, the slide deck. And on top of that, a member of our team will be reaching out to see if you'd like us to run the portfolio analysis like the one we reviewed today. So I hope everyone in our family continues to stay safe and well, and enjoy the rest of your week.